The last few years will be remembered as among the most extraordinary in modern American history. And I think it makes sense to take a quick walk through history and revisit some of the things that happened. A storm was gathering in late '06 and '07, and originally when it burst with Bear Stearns in March of '08, it was the beginning of something, but it looked like it may be a normal storm. Every 5 to 7 years, the country has faced various crises, not like the one we went through here, but various crises from the '01 internet bubble, the '97 emerging markets crisis, the '90 real estate banking crisis, the '87 market crash, and the last global synchronized recession in 1982. But after Lehman went down on September 15th, '08, it obviously was part of a much broader and far more serious series of events. Fannie Mae, Lehman, Bear, AIG, Merrill, which was sold to Bank of America, Wachovia, which was sold to Wells, auto companies, banks around the world started collapsing. And obviously, we had cardiac arrest in the capital markets for a very short period of time there. Even AAA companies could not raise money in the public capital markets. It always makes sense to look at all of the fundamental causes of a crisis. Albert Einstein says, keep things as simple as possible, but no simpler. We need to do this to understand and fix what happened. At the epicenter, bad mortgages, bad mortgage underwriting. People had gone from writing loans from 80% LTV to 100% LTV, and instead of verifying income, taking people's word for it and underwriting it. These mortgages ended up in CDOs, they ended up in derivatives. There were bad actors in it that did a terrible job underwriting, and there were some who actually did a fairly good job, but as it turned out, anything with some of those underwriting characteristics was bad. We had a huge housing bubble that burst, fueled somewhat by bad policy around Fannie Mae, Freddie Mac, and some government policies. There was leverage everywhere. Hedge funds, investment banks, European banks, which are still far more leveraged than American banks, private equity, and even universities, who started to make more and more commitments into private equity going forward, and those are kind of a form of leverage that isn't actually counted for as leverage. There were huge structural flaws in money market funds. You read about some this morning in repo markets. We all knew that the break-the-buck problem in a money market fund could be a problem. And there were regulatory lapses and mistakes, but I want to make the point clear, no business has the right to ever blame a regulator for what they did badly. But it also makes sense to analyze what we missed in regulatory. There were silos, there were gaps, half the mortgage business was not regulated. Basel II didn't even include liquidity as a measure of risk. And almost all of the things that companies faced and continue to face are pro-cyclical. Certain accounting rules, market rules, regulatory behavior are all pro-cyclical, and in the middle of a crisis actually make the crisis a little bit worse. There were huge trade and capital imbalances, and I think to think they'd sort themselves out nicely was wishful thinking. And a lot of people, I think when the economists write books in the future, they're going to talk about how that was one of the underlying causes about how interest rates stayed so low, fueling a lot of speculation. And I do think compensation derivatives played a part. They did not cause the problem, but you could say they aggravated and amplified it in certain situations. Our government, unfortunately, did what America has done many times over, took some bold, brave, dramatic, unique action. I think Secretary Hank Paulson, Ben Bernanke, Tim Geithner, in the middle of that crisis, probably stopped things from getting a lot worse. Books will be written for years. I personally believe they stopped it from getting a lot worse. The fiscal stimulus package, the mortgage modifications, TALF, and a lot of Fed programs, which I think were very creative. The stress test, I think it started badly, but it ended properly to certify that our banks were sound. Clearly, that should have been taking place before the crisis. One of the amazing things about all the things I just mentioned, and there may be other causes, they were all known. There was not one thing among them that was a secret or a surprise. But nobody anticipated that it might cause a snowball effect in the markets and unravel the way it actually unraveled. Many want to place the entire blame on big banks or big business. Some actually want to place it on big government. None are solely to blame, and none are absolved from blame. There's plenty of blame to go around. And clear responsibility begins with some of the financial companies who are at the epicenter, some of the bad risk management. There's valid anger over banker comp. There are a lot of companies that went bankrupt. They almost took down our country, and people walked away with a lot of money. Well, it angers me too. The regulators didn't always enforce the rules they did have properly, And many individuals should take responsibility for their own actions, either debt they took on they shouldn't have taken on, or institutions. But it is a mistake, in my opinion, and Sue mentioned it, thank you, to blame the reckless and the irresponsible the same way you're blaming the responsible and the prudent. Okay, not everybody did the same thing. Not everybody was bad. I think it's become a bad part of American society that we just denigrate whole groups of people without any discrimination whatsoever. That sometimes includes Congress, business, media, and they're not all in the same place. Some people actually do a very good job and care to try to do the right thing always for their country and their companies. It's pretty obvious that our regulatory system needs a major overhaul, and I think we now have the opportunity to develop a more cohesive, forward-looking, comprehensive regulatory system. What we need is good regulation. It's really not a question of more or less. It's to make sure it's good and effective, and it needs to be based on facts and analysis and not on populism. We have supported actively, J.P. Morgan supported actively many of these regulations, but there are some, before I go to the ones we do support, there are these misconceptions driving these policies. One misconception that all banks would have failed. This has become a reason to punish everybody. It is not true that all banks would have failed. A lot of banks had a lot of capital. They had a lot of liquidity going into this crisis. J.P. Morgan, I'm speaking for a lot of banks here, we did not have a run in the bank. In fact, our capital deposit was coming so fast, we actually didn't know what to do with it. Many companies lent into the crisis. Bear Stearns, we lent to California, WAMU, all those things that put a lot of capital out there to support the crisis. And I think you would have other banks saying exactly the same thing. They try to do what they can. In fact, we put $65 billion out at one point into the interbank markets, including to the UK banks, to help them in their times of need, which may tell you a little bit why we get a little upset when certain things like some of these bonus taxes in the UK take place. When the government ran its own stress tests, J.P. Morgan had $50 billion, I believe, more capital, tangible common equity than was required, and that wasn't a modest percent. It was something like 50 or 60%, so the government's own stress test proved it. Throughout the crisis, we never posted a quarterly loss. In fact, we were a safe haven for depositors, and we try to work as close as we can with the federal government in HAMP programs, in lending programs, and to lend into the marketplace. Another misconception is that banks stopped lending. They did not. Bank lending actually is higher today than it was a couple years ago. Bank lending in October, November, December went up right into the middle of the crisis. But one thing that's very noticeable, that in the American financial system, something like 65% of the lending is not done by banks. And a lot of that non-bank lending, which includes shadow markets, hedge funds, some of the SIVs, et cetera, actually disappeared. Almost $1.5 trillion, a lot of which was replaced by the Fed. So you do get the complaints that lenders stopped lending, but it wasn't the banks. And so I think when people say it was the banks, we actually had a run on the capital markets, which we'd never had before. And I want to ask you, this is interactive, so get ready. How many of you, after Lehman Brothers went down, did something more conservative with either your money or some institutional money you're responsible for? Raise your hands. Okay, you caused the crisis. And all of America, when I go around, they answer that question, and none of you were acting badly. You didn't want to hurt the country. You were acting to protect yourself or your company. It's completely appropriate. But we had that happen all at once in the markets, and it was something we'd never actually seen before when companies couldn't roll over their paper. J.P. Morgan, in the last years, extended $1.3 trillion of credit across all some was syndicated out, but across all consumer loans, all credit loans. Some was to restructure companies, which gets people back to jobs. And some of it was done in what I would call very difficult environments. I think you noticed we lent $1.4 billion to California when no one would. We lent money to hospitals when no one would. We lent money to Illinois, to New Jersey when no one would. And a lot of companies we were funding in the middle of this crisis, including some big bridge loans, et cetera, to make sure they could continue to do what they can do. Lending has gotten smarter. I think that lending tightened up, obviously. Loans are coming down now because both consumers and companies are being a little more careful. But I think the lending that's being done is wiser and will put our country in better shape over time.